Welcome to your daily options and futures trade update from Share Navigator. I'm Stephen Cox, CEO and full-time financial trader, and we believe that education is trading power. These updates will show you our real-life options and futures trades, the what, the when, and how we manage these options and futures trades on an ongoing basis. Simply the best way for you to learn. Today, we're going to start off by discussing the existing short put option that we have on the December crude oil futures contract. That's going very nicely. We're up $300 a contract since we started that trade. Second, we're going to discuss our next crude oil futures contract short put, and that's got a 90% probability, so you're going to want to watch that one. And then finally, we're going to discuss a potential call option trade on CTRA Energy and EOG resources. So let's get stuck in. So here's our existing put on crude oil December futures contract. And you can see we sold a $55 put. So just a brief reminder, we basically insured the value of the December futures crude oil contract to the value of $55. When we put the trade on, it was at $60. That allowed the crude oil to fall, which it did, but it didn't fall too much, which was great for us. We took in a premium of $487 after all costs. The value of that is only $158 now, which is great for us. And we're up, as you can see, $335 a contract now in this trade. So just a quick one on that. I've got a limit order in to close this trade out at 0.09, good to cancel. So if we get filled on this one, which means closing it down, we'll take away pretty much 70 to 80% of our max profit. We're going to open up the next one. So that leads me into the next trade. And again, we're going to go in and look at crude oil again. Now, there's different ways you can do this. I've spoken about that before in previous web meetings. It depends on the size of your account. You can use USO as a proxy if you want, or MCL, which is a micro version of this contract. So this is the main futures contract, which is expensive. It can be like $50,000. You don't have to have that in your account, but you need to know what your potential exposure could be. So if you wanted to do a lower version of that, which is a tenth of the value, it's the MCL contract, micro contract, okay? So we're going to look up for our next trade. And just a reminder, we're not opening this until our existing crude oil trade is out, okay? So this time we're actually going to give it even more wiggle room. Crude oil today is trading at $58. But let's say something goes wrong, I don't know, for whatever reason, we're actually going to sell the $50 strike. So we're being quite conservative here. And you can see we're taking in a 1% premium here. And if we put the trade on today, for example, we'd be taking in about $560 in premium, and the trade would have a 91% probability of profit. So again, just a very quick reminder as to why the probability of profit is so high for people who might be new to trading. We'll show you this really quickly. So if you look at this chart here on crude oil, as you can see here, at the moment it's trading at $58. We're basically saying, you know what, if it fell to 50, we'd buy the futures contract. So in other words, we're getting paid today to ensure the value of somebody else's futures contract for a much lower price. We don't, we don't have to, or we get paid a premium for providing that insurance policy. And therefore, if the value of crude oil goes up, we win. If it goes sideways, we win. And if the value of crude oil falls, but doesn't fall below 50, we win. So we win in three different ways. That's why the probability of profit is so high in it. Doesn't mean it's a guarantee, folks. I'd like to stress that, but it just goes to show you what you can do. So that's the next trade we'll be lining up. So just very, very quickly in summary on crude oil, we have a limit order to close this down if it gets it down to a market value of $90. At the moment, it's at a market value of 152. So if you're putting in a limit price, 0.09 on is the limit price you're putting in, okay? If you wanted to trade the micro version, MCL is your ticker, okay? So finally, we're going to look at some call options here, potential call option trades. And if you look at, for example, CTRA Energy. So CTRA Energy, guys, they generate roughly 50-50 their revenues from oil and gas, okay? So it's a 50-50 split. Roughly, it can be 52-48 depending on the price. So natural gas has actually started to increase recently. We know crude oil, if you think crude oil's at a base, if you were to look at a chart of CTRA Energy, for example, you would see it's at a low at the moment. So if you felt natural gas is going to continue to rise and maybe crude oil is going to continue to rise, maybe buying a call option on CTRA Energy would be a good idea. The stock is currently trading at 23.32, as you can see. We like to give it about 90 days for the trade to work out. And we like to go for deltas in and around zero point 0.7. Now, if we go out to the January expiry, we're looking at maybe the 22 strike. So the delta is not quite zero point 0.7, but that will do. You can see the last time it traded, it was at 218. So we'd be spending $218 a contract. And our rule of thumb in buying call options is if the value of that got up to, let's say, between 320 and 330, we would close out and we would make a profit of about 50-60% of our investment. So that's one trade we're looking at. The January 16th CTRA Energy $22 long call option. One word of caution with CTRA Energy: earnings are coming up next week. So earnings, as we know, can cause the share price to jump, or it can cause the share price to fall. That's the risk you take with something like this. But because we've done so well in our portfolio this year, we see this as a trade that, look, it's not that expensive per contract to put on. We're happy to take a risk on that. The other one in a similar space, and the only difference between this and CTRA Energy, they have a much higher exposure to crude oil. So if you didn't fancy crude oil, for example, and you felt the value of crude oil wasn't going to rally or rise, well, then maybe you'd hold off. Again, this is been trading sideways and it's at a low at the moment. Again, we go out to January, we would look at a delta of 0.7, which gives us the $100 strike. And you can see the cost of that. It's about $1,000 a contract there. And again, we would close this out if it got to $15. So there wouldn't have to be that much of a rise in the value of EOG for us to make a profit. So there are two potential trades that if you fancy crude oil, you felt crude oil was going to maybe rally from here, or at least not go down any further, there is potential for those stocks to rally. And by the way, earnings for both of them is something you've got to consider. Finally, I'd just like to have a very quick chat about silver. I was asked about silver yesterday, and just to say that I'm not a fan of trading this at the moment, but I was asked to look at it, so I will. And if we just look here at the chart of silver, we've had a significant pullback in the last couple of days. So I don't know if you remember a web meeting last week that I did. My view was, if you felt that this short-term volatility over the banks in the US was just short-term stuff, then maybe time to lock in your gains in gold and silver. Well, look what's happened since. The minute the volatility came out of the stock market, silver kind of sold off heavily. And by the way, my view is that could fall even further. There's no guarantees either way. So I'm not a fan of trading it. Having said that, if it did come back another 10 to 20%, I do think it might be a worthwhile opportunity to do a call option on it. Because normally when an asset reaches a high like that, it gives it another retest at some stage. I just don't fancy it at these prices because the downside is so much. Okay, folks, that's it for today. If you have any questions or comments, please let me know and I'll be happy to answer them. Thanks and bye for now.